A few weeks ago, I saw a tweet by Stephanie Pomboy. If you are not familiar with her, she founded the global macro research company Mavens 20 years ago in 2002, or around 20 years ago. And she put out this tweet saying permanent QE begs the question, why isn't gold much, much higher? Why is it only around $1,700 an ounce? The current gold price is a little bit above that at $1,720 an ounce, give or take, although recently the paper price of gold has been smashed. But there has been an extensive amount of rules changes, paper price manipulation, and other games in gold, although from a fundamental standpoint, it appears that Indian physical gold demand and Chinese physical gold demand has stopped for now because the global economy is not functioning. So people in India, in China, who are normally buying lots of physical gold with their excess profits and storing their savings in gold are not doing so right now. However, I think there is a lot of paper price manipulation with the normal types of smashes to try to cap the gold price around $1,700 an ounce for at least the last 2 months or so, give or take. So there is historical precedent. If you're not familiar with the manipulation of the gold price, the London Gold Pool was the most recent example of extremely well-documented public intentional manipulation of the gold price, the most extensive form of recent manipulation in gold. And not too long after the London Gold Pool dissolved, then the gold futures contracts came in to try to manipulate the gold price further. So the London Gold Pool was manipulating the gold price in the 1960s. It is extremely well documented through Gold Antitrust Action Committee, and you could take a lot of research there. And we have a more modern, more sophisticated version now of paper price manipulation in gold with high frequency trading algorithms and the rules changes that I'll talk about later in this video that have happened in the last 8 or 9 weeks. Stephanie's brother, Eric Pomboy, who advises hedge funds, also was tweeting recently about gold, talking about how the Fed is clueless and that he is advising his hedge fund clients to accumulate more physical gold. Before the coronavirus, a lot of central banks were not buying U.S. treasuries. They were buying physical gold. So that's what led to some of the repo problems. That's what's led to the Federal Reserve having to step in and buy a lot of U.S. treasuries, is because the global economy was not functioning too well, global trade, and the coronavirus has made things even worse. But there was a massive amount of central bank gold buying, as you can see here in this next chart, prior to the coronavirus. Here is the chart with massive amounts of central bank buying. It has been spiking in the last couple of years. They added 650 tons to their reserves in 2019, the second highest shift in 50 years after the 656 tons added in 2018. Central banks were accumulating a lot of physical gold prior to the coronavirus. However, now that the global economy is not functioning normally, there is not as much trade surplus to reinvest into, to store savings from a country into physical gold for now. So what is driving gold's demand? The central bank balance sheets are expanding faster for the Federal Reserve, the European Central Bank, the Bank of Japan, the People's Bank of China, the Bank of England, on and on and on. Over $20 trillion in liquidity in just the last couple months, with a combination of central bank balance sheet expansion and also government fiscal stimulus spending. Just insane. The gold price is being driven by central bank balance sheets expanding faster, interest rate craziness with the talk of negative interest rate policy, which I think negative interest rate policy would benefit holders of gold because you would not be paying banks to store your savings at the bank by holding physical gold. Gold wins in a negative interest rate environment, in my opinion, or massive currency devaluations that are already starting to happen with a lot of emerging market currencies. And all these things combined will accelerate the gold bull market. The price of gold in other currencies other than the dollar is already at or near an all-time high. We have currency instability, I think, which is good for gold. Gold also does well, shockingly, in a debt deflationary scenario, which is what happened after the October 1929 crash. As I discussed in my interview with Lynn Alden, this is the best historical example we have of how well gold has performed in a deflationary scenario. Daniel Amerman has written extensive articles about how well gold has done in a deflationary environment. We also have Homestake Mining and Dome Mining, which were the two major gold miners on public exchanges during that deflationary scenario, and they both did superbly. And gold's track record of doing well in inflationary environments is pretty well known. So you have volatility in other asset prices, volatility in stocks, bonds, real estate, probably also good for gold. And finally, many generalist money managers with billions in assets under management are not allowed to buy physical gold or the GLD, which I don't like. So what will they buy as a proxy for gold exposure instead? And that is why, in my opinion, the price action in the best run, larger, and safest gold stocks appears to be accumulation on dips for the last month or two. This is a chart I made going back to the bottom, the liquidation event on March 20th for the US Global Gold and Precious Metal Miner ETF, or GOAU. This is Frank Holmes' US Investors one. It has Franco-Nevada in it. It has Sandstorm Gold in it. It has other royalty and streaming companies in it. And it has some better gold miners based on other fundamental metrics. So as you can see there on your chart, it looks like whenever this chart was dipping, there was accumulation periods where the dips did not last very long. So if there was painful dips, they were bought, at least in the past over the last couple months. This is a recent tweet by hedge fund manager Tavi Costa, who I also had on my podcast in the last 6 or so weeks. And he was saying that the junior mining stocks could be prepared for a breakout in the not too distant future. Although a lot of junior mining stocks, you have to be careful with those individual companies because and also the GDXJ does not really have juniors. So even though the GDXJ might go up, there's not actually a lot of juniors in the GDXJ. It's mostly older and smaller producers that are not big enough to be in the other indexes. So if you want real exposure to juniors, there are other options that I talk about behind my Patreon account paywall. But he is just showing here that now more money is starting to move into juniors. And we could tell this by how much fundraising the juniors have done in the last 4 to 6 weeks. There's been a pretty decent amount of fundraising, at least for drill programs for a lot of these juniors, although nowhere near enough to build a lot of new gold mines, but enough to start doing some drill programs, which is good for the industry overall. But clearly you need more capital to build the mine. So we're nowhere near those levels yet. Again, I have an article behind the paywall on my Patreon covering this more in depth if you want to take a look for only $5 a month. In my opinion, gold is temporarily being capped below $1,800 an ounce, around $1,700 an ounce. And for past gold manipulations where gold has been capped, those paper price manipulations, they only work for a certain amount of time at certain levels. So if the manipulators had won, gold would have never gone above 1,000. Gold would never have gone above 1,100 or 1,200. Do you see what I mean? So they can't defend the paper price manipulation, whoever's doing it, whether it's a combination of central banks, bullion banks, hedge funds, whoever's involved in this, treasury departments, who knows, finance ministries, who knows. Maybe a combination of all these, especially with the RICO charges that JP Morgan and other banks are facing. But they can't cap prices permanently, gold prices permanently at $1,200 an ounce or at $1,300 an ounce or at $1,400 an ounce, because the miners will eventually mine all of that economic gold, and the mine supply is required to meet gold demand. Because as much above ground physical gold as there is, a lot of it is not for sale, especially at current market prices. So silver at or below $15 an ounce was starting to create shortages of physical metal, with copper miners in trouble. The managed retreat, which is what James Turk of Gold Money has called it, is still in effect, but slower than people expect for now. So we will get to higher gold prices. It just might take more time than people think. But my portfolio is set up to benefit with gold companies, precious metal, the larger precious metal royalty and streaming companies, that actually the more paper prices are manipulated, the more deals, smart deals for long-term cash flow they will do. And this is what you're going to see probably in the next 6 months or so, 6 to 12 months, depending upon how long gold prices stay this low, is you're going to see another round of large deals by the Franco-Nevadas, the Wheaton Precious Metals, the Royal Golds, the Sandstorm Golds, maybe even a Cisco Gold Royalty. And I think Mavericks Metals even just did a small capital raise with Pan American Silver to maybe do another deal in the not too distant future. All the sophisticated scheme that I'm going to talk about, some of the stories, is this generation's version of the 1960s London gold pool ending. So in the last 2 months, the LBMA and COMEX, London Bullion Metals Exchange, and COMEX have done over a half dozen rules changes. This helps cap paper prices temporarily. This is an interesting quote I found. If you can't win, change the rules. If you can't change the rules, ignore them. And I think this is applied a lot to the economic and political elites in power, the central bankers, the politicians, the bureaucrats, the bullion bankers. This is just how things work, unfortunately, in the new normal, that people who have been expecting higher gold and silver prices have had to deal with for years now. So there's been a lot of rules changes. Let me start talking about them now. So Ronan Manley has been covering this extensively, talking about new rules changes and collusion between the LBMA and COMEX. I highly recommend reading some of these articles that I'm going to just briefly touch on in this short little video. I'm not going to read the articles, so I just want to show some of the different rules changes because there's quite a bit of them. So the rules changes started around the end of March, and this was to prevent gold from going, in my opinion, from going to $1,800 an ounce or over maybe $1,900, $2,000 or higher. And the CME pushed to change gold delivery rules. Roy Sabag, the CEO of Gold Money, who trades a lot. Gold Money does a lot of physical gold and silver sales and trading. So they would know because they have to have contacts in COMEX and LBMA. So the rules changes started around the end of March. Then the rules changed again for what could be delivered. Then, of course, and people who have been around a long time like me in the gold and silver markets, this is exactly what slowed down gold and silver's rise in 2011. Margin requirement rules changes. So margin requirement rules changes. Anyone who's long gold or silver futures contracts, paper futures contracts on the COMEX, and first of all, those are the only two contracts for gold and silver where there's actually very strict position limits on the long side. And then the margin requirements start coming in. And once the margin requirements keep getting increased, normally because they don't have the metal that they claim to actually have in the vaults, because they claim always to have lots of metal in the vaults, and normally they never have anywhere near that amount of metal in the vaults. So they start raising the margin requirements to try to keep the paper prices in check, to cap them temporarily for a while. Okay, next slide. Rules changed to avoid a default. The London, New York markets default on gold deliveries. Again, they're just going to keep changing the rules. If you want to read more about the details, you have to really read these articles. Another margin requirement rules change. This is another rules change, the LBMA gold price benchmark, ignoring market conditions for changing investors. So they're just going to keep changing the rules in many different ways. And this, it doesn't knock the gold and silver price anywhere near the damage that it used to. So the gold price is not back down to 1,200. It's not even back down to 1,500 because clearly global macro situation is still very tenuous. This is one of the crazier things I've seen in the last couple months. We found out from a Reuters article that HSBC Bank lost $200 million in a single day on paper as the dislocated gold market. So for those of you who are not familiar, they are the custodian of GLD, and this goes into the exchange for physical and problems with that. This slide is Ronan Manley's article that I really think is recommended reading. There's two more articles too by Craig Hemke or Turd Ferguson that I'm going to show in the last two parts of the slide deck, where I think those will explain more of the crazy details that have happened in the last couple months. But if you read this article, it shows that HSBC Bank, which is the custodian of GLD, could not source physical gold for deliveries for futures contracts or for the GLD, and that the Bank of England, they had to borrow physical gold from the Bank of England, and the Bank of England is absolutely furious with them. So the Bank of England bailed out HSBC Bank, helping them to prevent a default in the gold market in a number of different ways in the last couple months. So the details are coming out about how HSBC Bank, the custodian of GLD, has had immense problems in the last couple months. And again, this is preventing a much higher gold price, but it's only temporary though. They haven't knocked the gold price back down below 1,500 or around 1,200. It hasn't happened. They barely kept the gold price down like 50, 60 bucks. The gold price is not above 1,800. The gold price should be a lot higher. We'll eventually get there, but my portfolio is set up now. My investment portfolio is set up to benefit from this managed retreat, from these paper price manipulation games. So if the bullion banks want to keep changing the rules, want to make it so the paper gold price, paper silver price doesn't rise, okay, fine. Well, Franco Nevada is going to do more deals. Wheaton Precious Metal is going to do more deals. Sandstorm Gold is going to do more deals. And these are going to be bigger, stronger, more diversified cash flow machines in the future. This is the first Craig Hemke article that came out detailing a lot of the rules changes and manipulation. He's Turd Ferguson, if you're not familiar with him. So again, I'm not going to go through his article, but he details a lot of the crazy things that have happened in the first article that came out April 7th. And then in the second article that came out last week on May 19th, A Crisis of Confidence, Part 2, about the craziness going on in the COMEX and LBMA. Finally, this is a summary of a lot of the different slides that I've talked about in the last couple of minutes. So the gold and silver price caps at current levels will eventually fail because demand for physical metal, the miners will not be able to keep producing the same amount of metal economically without draining reserves. And then they need to replace those reserves with higher cost metal. So this is just how it is. But I've been in this now for over a decade, and I think I understand how the scheme works fairly well. And it involves a lot of rules changes, so that's why gold price is not at $2,000 an ounce or higher yet. We'll get there, but not yet. So if the people in power, the bullion banks, the central banks, the treasury departments, the high-frequency trading algorithms, the hedge funds that hop on, the futures traders that are in the pit that want to hop on the manipulation trade, they want to knock the paper price down, fine. My companies that I'm invested in are going to benefit from this long term. So the price caps at 1,200, the price caps at 1,300 and 1,400 have all failed in the last 12 to 14 months. So this fits in with James Turk's managed retreat thesis, even though a lot of gold bugs and silver bugs are really frustrated and angry, but patience is key here. And this is why you don't buy all of your gold stock positions at once. This is why you have cash in case there smashes. If there is smashes, maybe the premiums won't be super high to go and buy more physical gold and silver. The price caps of certain gold and silver prices with rules changes and paper price manipulation only work now for a certain amount of time before the price cap can no longer be defended. That's the analysis I've had, that the law of diminishing returns is now in full effect. So whereas in the past, in 2007, 2008, 2009, some of these smashes might take 6 months, a year even, maybe even longer than that to recover from, these things are recovering in a couple weeks or a couple months now. Their recoveries are a lot faster, especially given, like what I said earlier about central bank balance sheets with potentially negative interest rates and all the craziness with currencies, especially emerging market currencies right now. Many larger gold miners need to make an acquisition soon to replace already mined supply just to maintain current production levels and replace mine reserves in the near future. So in the next couple years, I think you're going to see a lot more larger gold and silver miners. Maybe the mid-tier miners are already starting to buy some quality juniors in the last couple years, but I think you're going to see more consolidation. And one of the main reasons is because a lot of juniors cannot raise capital on their own to build a mine. So the juniors are either going to need to have a joint venture deal, like with what Mag Silver has with Fresnillo, how they're splitting it. It's almost 60-40. So I think Mag Silver has a little bit higher than that. So either the larger miner, the senior miner, or mid-tier miner will buy out the junior outright because the junior can't raise the capital on their own to build a mine, or there will be some type of joint venture deal. Because the more gold mined, the tougher it is to replace the mined reserves and the annual production. So investors, long-term investors in these larger gold miners like a Newmont Mining or Barrick Gold, they're going to want to see reserves replaced. And a lot of these larger gold miners don't spend a lot on exploration budget. Now, they may occasionally make a little investment here or there into a junior, but a lot of those might not work out so well. So investors other than Eric Sprott are starting to fund juniors again, although in bought deals and private placements with tiny amounts of capital for drill programs. Again, not enough to build a mine, though, for most miners. So this is what the industry faces. The industry for juniors is starting to raise capital for drill programs and maybe move a resource along, maybe to an NI 43-101 for those resource companies up in Canada on the TSX Venture, but not enough to build a mine. We are nowhere near those levels to build a mine yet. So I did a summary then of the gold mining industry, along with a number of the crazy rules changes that have happened in the last 8 or 9 weeks, including margin requirements, including changing what is an acceptable delivery for gold bars. And then we know the details, or some of the details at least, with the Reuters article and the Ronan Manley article, which came out on May 13th. I highly recommend reading that because it's extensively detailed about the Bank of England having to come in, step in, and help out HSBC Bank with physical gold for gold futures contracts and also for the GLD.